One of the first questions people ask when they're thinking about getting a mortgage is what size mortgage can I afford? One of the best ways to think about the answer to this question is to figure out how much of your net income you want to spend on your monthly mortgage payment and on total monthly housing expense, which is your monthly mortgage payment plus other housing related expenses such as property tax, homeowners insurance, and homeowners association or co-op fees if applicable. The size of your mortgage payment and total monthly housing expense you can afford, as well as your current monthly debt, will determine the size of mortgage you can afford. The most important thing is that you're comfortable with your mortgage, but people usually want to understand what's the maximum amount of their income they should spend on their monthly mortgage payment and total housing expense. There are three key numbers to think about when it comes to determining what size mortgage you can afford. The first is your monthly mortgage payment. The second is total monthly housing expense, which, as we discussed, is your monthly mortgage payment plus property tax, homeowners insurance, etc. And the third number is total monthly housing expense plus other monthly debts such as credit card, auto, and student loan payments. There are no hard and fast rules on how much of your monthly income you should spend on these figures, but there are some general guidelines that we can apply. Borrowers typically spend a maximum of approximately 43% of their monthly net income on their mortgage payment, a maximum of 52% of their monthly net income on total monthly housing expense, and a maximum of 62% of their monthly net income on total monthly housing expense plus other monthly debt. I want to emphasize that we are talking about monthly net income, or your income after deductions such as taxes, Social Security, and Medicare, so your take-home pay. I'm going to walk through a couple of examples to demonstrate how the guidelines work. Let's say our borrowers make a combined $5,000 a month in net income. 43% of $5,000, or 0.43 times 5,000, equals $2,150, so the borrower can afford a monthly mortgage payment of $2,150. Next, we have total monthly housing expense. 52% of $5,000 equals $2,600, so the borrower can afford to spend $2,600 on monthly housing expense, which means they are spending approximately $450 a month on non-mortgage housing expenses such as property taxes and homeowners insurance. Finally, we have total monthly housing expense plus other debt. 62% of $5,000 equals $3,100, so the borrower can afford to spend $500 a month on other debts such as credit card and car loan payments. Let's look at a second scenario now. Let's say our borrowers still make $5,000 a month, but they don't have $500 in monthly debt. Instead, let's say they only have $250 in monthly debt. That means our borrowers can spend more on total monthly housing expense and their monthly mortgage payment. Let's walk through the numbers. This time we're going to start at the bottom of the table with total monthly housing expense plus other monthly debt and work our way up. Because our monthly net income does not change, our borrowers still spend $3,100 on total monthly housing expense plus other debt. But because we only have $250 in monthly debt instead of $500, our borrowers can now spend $2,850 on monthly housing expense, and keeping our non-mortgage housing expense constant at $450 a month, they can now afford to spend $2,400 on their monthly mortgage payment, up from $2,150. The higher your monthly mortgage payment, the larger the mortgage you can afford. So this example demonstrates a couple of points. First, the less monthly debt you have, the more you can spend on your monthly mortgage payment, and the larger the mortgage you can afford. And second, our mortgage affordability guidelines are not set in stone, but rather can be influenced by several factors. After you determine what size mortgage payment you can afford, you can figure out what size mortgage you can afford. Let's continue with our example and say that our borrowers can afford a mortgage payment of $2,400. What size mortgage our borrowers can afford depends on the interest rate and term, or length, of the mortgage. Let's look at a 30-year fixed rate mortgage, which is the most common type of mortgage, and three different interest rates: 4%, 5%, and 6%, and show what size mortgage our borrowers can afford at each interest rate. With a 4% interest rate, our borrowers can afford a $500,000 mortgage. At a 5% rate, a $445,000 mortgage, and at 6%, a $400,000 mortgage. As you can see, the higher the interest rate, the lower the size of mortgage our borrowers can afford. This is because our monthly mortgage payment of $2,400 does not go as far with a higher interest rate as it does with a lower rate. Please check with your lender to make sure that you can qualify for the mortgage that you're seeking, as lender mortgage qualification guidelines vary. To review lenders in your area, simply click on the green Compare Lenders button on the top of any page on freeandclear.com. Now that you understand the fundamentals behind determining what size mortgage you can afford, we encourage you to watch related videos on freeandclear.com, such as what price home can I afford and what mortgage program is right for me. And also check out our mortgage qualification calculators and home purchase mortgage process guide. Thank you for reviewing What Size Mortgage Can I Afford with freeandclear.com. Free and Clear.